Listen up, the market just told us a story this past week and you need to pay attention. The bulls came out to play and they were not messing around. We saw some serious green across the board, a beautiful sight after weeks of nail biting and hand wringing. The big indices, the ones we watch like hawks, all finished the week with strong gains. This wasn't some fluke, some one-day wonder. This was a sustained rally that had real power behind it. Investors who had been hiding under their desks finally peeked out and decided it was safe to buy. That's the kind of action we love to see. So what lit the fuse on this rocket? Two big things. First, the jobs report came in hotter than a $2 pistol. The economy is creating jobs, people are working, and that means they have money to spend. That is the lifeblood of our economy, folks. When people are employed, they buy cars, they buy iPhones, they go out to eat. That's music to Wall Street's ears. Second, the noise around tariffs and trade wars got a little quieter. The shouting match seemed to cool down, and that calm was all the market needed to feel a whole lot better about the future. This rally wasn't just about the big guys either. Sure, the Dow Jones and the S&P 500 had fantastic weeks, climbing higher and making people feel confident again, but the real story, the one you need to dig into, was in the Nasdaq and the Russell 2000. Technology stocks were on fire. The innovators, the game changers, the companies building tomorrow, they led the charge. And the small cap stocks, the little guys in the Russell 2000, they also had a tremendous run. That's a sign of a healthy market when the buying is broad and includes the smaller, domestic focused companies. It tells you the rally has legs. When you see this kind of broad-based strength, you have to respect it. It's not just one or two mega cap stocks pulling everything up. It's a sign that investor confidence is returning across the entire spectrum of the market. People are betting on American innovation and American growth, from the biggest behemoths to the scrappy up and comers. This is the kind of setup we dream of. It's a signal that the fear that gripped the market is starting to fade, replaced by a cautious but very real sense of optimism. Now, the bears might have had their picnic, but the bulls are back and they are hungry. In any given week, you've got your heroes and you've got your zeros. It's the nature of the beast. This past week, the hero cape was worn by the tech sector. A certain semiconductor company, let's call it a leader in graphics processors, absolutely soared. It was a monster move, driven by excitement about artificial intelligence. Investors are piling into anything and everything related to AI, and this stock is the king of that hill. On the flip side, we saw some pain in the energy sector. Oil prices took a bit of a tumble, and that dragged down the big oil producers. Remember, no sector goes up forever. There's always a rotation. Now let's talk about the big picture. We can't just keep our eyes on Wall Street. What happens in London, Tokyo, or Frankfurt matters a lot. Global markets are all connected like a giant web. If Europe's economy sneezes, our market can catch a cold. This week, we saw some positive signs from overseas markets, which help boost the mood here at home. When international investors feel good, they often buy American stocks because they see the US as a safe and strong place to put their money. A rising tide globally helps lift all boats, including our own. Think about it. The biggest companies in the S&P 500 don't just sell their products in America. They sell them all over the world. A tech giant sells its phones in China. A fast food chain sells its burgers in Germany. and a software company sells its services in Brazil. So if the global economy is doing well, that means more customers and more profits for our companies. That's why we always have to watch the international data. It's not just some academic exercise. It's about understanding the true earnings power of the companies you own. Never invest in a vacuum. This week's scorecard showed some clear trends. The winners were the companies building the future, the tech innovators, and the small, nimble businesses poised for growth. The losers were tied to older industries facing some headwinds, like fluctuating commodity prices. This is the classic battle in the market: growth versus value, new versus old. Right now, growth is winning the day. But you have to be ready for that to change at a moment's notice. The key is to know what you own and why you own it. Don't get caught chasing last week's winners without a game plan. All right, buckle up, because the week ahead is a total minefield. We've got a lineup of events that could send this market flying high or crashing down. First up, we get the inflation numbers, the Consumer Price Index, or CPI. This is the big one, the heavyweight champion of economic reports. It tells us how fast prices are rising for everything from petrol to bread. If that number comes in hotter than expected, it could spook the market into thinking the Federal Reserve will have to keep interest rates high to fight inflation. That would be bad news for stocks. Next, we have the Federal Reserve's meeting. Jay Powell and his crew will get together and decide what to do about interest rates. Nobody expects them to cut rates at this meeting, not a chance. But what we're all listening for is the commentary. We'll be hanging on every single word Powell says. Is he worried about inflation? Does he think the economy is strong enough? His tone will set the market's mood for weeks to come. If he sounds hawkish, worried about inflation, look out below. If he sounds dovish, more confident that price pressures are easing, the bulls will run wild. Then there's the international drama. High stakes trade talks are happening between the US and China. These two economic giants have been in a tense dance for years, and any news from these meetings could cause major ripples. If they signal progress, that would be a huge relief for the market, especially for companies that rely on global supply chains. But if the talks break down or the rhetoric gets heated, it could bring all that tariff uncertainty roaring back. This is a wildcard that could trump everything else, so we have to watch it closely. And for all you tech investors, the main event is Apple's Worldwide Developers Conference, or WWDC. This is where the most valuable company in the world shows off its new software and gives us a peek into its future. Everyone is waiting to hear about their strategy for artificial intelligence. If they unveil something revolutionary, it could send Apple's stock and the entire tech sector is soaring. If it's a disappointment, it could take the wind out of the tech rally sales. And this is a make or break moment for the biggest stock in the market. No pressure on. So here we are, standing at a crossroads. The market has momentum. The bulls have the ball. But the path ahead is littered with obstacles. It's a classic Wall Street showdown. On one side, you have the positive energy from the strong jobs report and the fantastic performance of key sectors like technology. The engine of the American economy seems to be humming along nicely, and investors have been rewarding that strength with their hard-earned cash. The desire to chase this rally is powerful. Nobody wants to be left behind when the train is leaving the station. But on the other side, you have a wall of worry. The risks are real and they are not small. The upcoming inflation report could be a party pooper. If it shows that prices are stickier than we'd like, it puts the Federal Reserve in a very tough spot. That leads us to the Fed itself. Their decisions on interest rates are everything right now. A wrong move or even a wrong word from the central bank could trigger a wave of selling. You also can't ignore the mountain of government debt, which hangs over the economy like a dark cloud. These are serious headwinds. This is why volatility is the name of the game right now. The market is being pulled in two different directions. You have the optimists who see a strong economy and innovative companies leading us to new highs. They believe the market can break through the current resistance levels and keep climbing. They're buying the dips and betting on the future. They see the upcoming events as potential catalysts that will prove them right and send stocks on the next leg up. They believe the breakout is imminent and that fortune favors the brave. But then you have the pessimists who see rising risks and an uncertain policy environment. They are worried that the good news is already priced in and that the upcoming economic data or Fed meeting will deliver a nasty surprise. They are taking profits, raising cash, and preparing for a pullback. So, what's the bottom line? Can the markets power through this gauntlet and break out to new highs? Or will the resistance hold, sending us back down? That, my friends, is the trillion-dollar question. This week will give us some big answers. Don't you dare miss it. Booyah!